During his most recent press conference, Jerome Powell, he is the president of the Federal Reserve, stated that the policy rate is meaningfully restrictive, which means that it is quite a bit above the neutral rate of interest. However, looking at the Q4 GDP data for the US economy, which was released during Thursday's trading day, it looks like the policy rate may not actually be that restrictive. Now, of course, I am in no position whatsoever to judge what Chairman Powell said, but I do think that in a way, it is unclear what Chairman Powell truly means when he says meaningfully restrictive. And if you simply, if you interpret the term as representing a policy rate that is quite a bit above neutral, well, then, after looking at this Q4 GDP data, it is certainly reasonable to jump to the conclusion that the policy rate is actually not that far above neutral. And in today's macro analysis, we will take a look at the Q4 GDP data and I will show you just how resilient the US economy still is. And we're going to do this all in the RStudio environment, and you can follow the coding here step by step. All right, first thing we're going to do is we're going to import two data sets. We're going to rename them. The data set 2024 includes GDP data up to 2024, and the historic data set is going to be used. We're going to use the historic data set to calculate standard deviations and the mean, one standard deviation upper and lower band. And this data spans from 2010 to 2019, which means that we can compare current GDP data to sort of a historic average to see how strong it is. So the first thing we're going to do is we're going to assess headline GDP growth. And in order to do so, we're going to use the bar plot function. And I think, of course, the plot in this case is already shown here on the right. We're going to run the code, and then we're going to calculate the mean GDP growth rate using the historic data set. We're going to calculate the standard deviation, and then we're going to calculate the one standard deviation upper band, which is the mean plus the standard deviation. And then we're going to add the mean and the standard deviation to the plot. The mean is the green line, the one standard deviation upper band is the red line. And you can see Q4 GDP growth is sort of equal to or very close to the average GDP growth rate from 2010 to 2019, slightly below. And of course, GDP growth is weaker than it was in Q2 and Q3. However, this headline number is very misleading, and I will explain to you why. And in order to do so, we're going to take a look at how much spending, consumer spending, grew in Q4 of 2024. Now, of course, we can clearly see here that consumer spending has now accelerated for 3 consecutive quarters. And when we calculate the standard deviation, the mean, and the one standard deviation upper band, and add those two as a line, we can see that consumer spending has now grown above the one standard deviation upper band from 2010 to 19 for 2 consecutive quarters, signaling that consumer spending, which is the engine of economic growth in the US economy, is still very strong. Now, we're now going to look at how much consumer spending contributed to GDP growth, which we can do using this plot. And we can, of course, see that it's very similar to consumer spending. When we once again calculate the standard deviation, mean, and one standard deviation upper band, and add those two lines to the chart, we can once again see that the contribution of spending to GDP has now been above the one standard deviation upper band for 2 consecutive quarters. And now you may wonder, well, if spending is so strong and spending is the engine of growth, why was the headline number more on the benign side of potential outcomes? And in order to explain this, we're going to take a look at non-residential fixed investment. And when we plot one non-residential fixed investment, you can see was negative for Q4. And when we compute the standard deviation and mean, and then actually in this case, we're going to calculate the one standard deviation lower band, which is the mean minus the standard deviation. And then we're going to plot, and then actually we're also going to calculate the 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 standard deviation, the two standard deviation lower band by subtracting two times the standard deviation, so two standard deviations below the mean. And then we're going to plot all of these lines. We can see here that for Q4 of 2024, non-residential fixed investment growth was below the two standard deviation lower band from 10 to 19, which just shows how weak non-residential fixed investment was during Q4 of 2024. And this is the source of a relatively more benign headline growth rate in GDP. But it is not indicating the resilience of the economy because this non-residential fixed investment was weak because of idiosyncratic factors that do not represent the health of the economy. For example, we had a Boeing strike. We had significant economic policy uncertainty because, of course, the election occurred in Q4. We still have economic policy uncertainty about the policies Trump will implement. On Saturday, we will get an announcement about tariffs or not. We don't know the impact of those tariffs on the economy. This uncertainty is a cloud over the US economy, and it is holding businesses back from investing. And this is what caused this non-residential fixed investment to be relatively weak. And then when we run this entire code, we can see that the contribution of this fixed investment is also below the two standard deviation lower band. Now, when we take a look at some other factors of consumer spending, for example, spending on services, spending on goods, we can see that spending on services remains strong. We can see that spending on goods is clearly rebounding. And then a more broad measure of economic resilience, which is real final sales to private domestic purchasers, that has also been strong. And then when we take a look at inflation for Q4, measured by core PCE, core personal consumption expenditures excluding food and energy, we can clearly see that we saw a slight rebound here in Q4, and due to residual seasonality, it may also increase in Jan of 2025. So the bottom line here is that the US economy remains very resilient. Consumer spending remains resilient. Inflation continues to remain sticky. So this data validates the Fed's patient approach to keep rates on hold, to keep rate cuts on hold, to keep interest rates steady for now, and assess further data, get validation of whether inflation continues its downward trajectory toward the 2% target. The December PCE report is expected to be more on the benign side. I believe the disinflationary narrative is still in place, but it was appropriate for the Fed to stay on hold. PCE data is next tomorrow.